The room went dead silent. For months, the market had been bracing for a standard, run-of-the-mill joint venture, the kind of predictable corporate marriage that keeps compliance lawyers happy and shareholders mildly amused. But what flashed on the projector screens at 8:01 a.m. wasn't a standard joint venture. It was a structural masterpiece that completely rewrote the rules of cross-border infrastructure finance. This wasn't just a deal, it was a highly engineered, three-tiered architectural marvel designed to bypass regulatory choke points while locking in institutional capital for the next 3 decades to understand how this mechanism actually works. We have to look past the flashy press release headlines and dissect the machinery piece by piece. The architecture relies on an intricate web of risk-shifting instruments, synthetic equity, and sovereign guarantees. When you peel back the corporate wrapping, the entire ecosystem boils down to 4 primary structural pillars, executed with mathematical precision. First, the core of the transaction is anchored by a dual ring-fence special-purpose vehicle, SPV, incorporated in a neutral, Tier 1 jurisdiction. This isn't just an accounting trick, it is the operational nerve center of the entire policy rollout. The SPV operates under a bifurcated capital structure designed to separate operational risk from asset ownership. Tranche A, senior secured debt. Comprising 55% of the total capital stack, this tranche is backed by first priority liens on the physical assets. It was entirely swallowed up by a consortium of conservative pension funds and sovereign wealth funds seeking predictable, long-dated yields. Tranche B, synthetic equity and mezzanine debt. Accounting for 30% of the architecture, this tier absorbs the initial operational shocks. It features an innovative yield flip mechanism. For the first 7 years, it functions as fixed-rate debt, after which it automatically converts into variable-rate equity based on performance metrics. The sponsor equity slice, the remaining 15%, is held jointly by the primary state-backed players, ensuring they keep significant skin in the game while absorbing the ultimate downside risk. By isolating the core assets inside this dual ring-fenced vehicle, the architects achieved a critical objective. They insulated the project from the balance sheet volatility of the individual corporate parents. If one partner faces a liquidity crunch or a political headwind at home, the SPV's internal statutory asset protection clauses prevent creditors from freezing the infrastructure pipeline. Second, the deal introduces a revolutionary tripartite risk mitigation framework that solves the perennial problem of currency mismatch and geopolitical instability. Historically, grand infrastructure initiatives stall because they earn revenue in local, volatile currencies but must service their debt in dominant global currencies. The architects solved this through a synthetic hedging facility backed by a multilateral development bank, instead of relying on expensive, short-term commercial currency swaps that roll over every 24 to 36 months. The partners engineered a rolling, 15-year macroeconomic stabilization protocol. Under these terms, if the local currency depreciates beyond a predefined structural band, a sovereign-backed indemnity fund automatically triggers, injecting liquidity directly into the SPV's debt service account. Furthermore, the political risk insurance layer is explicitly unbundled. Rather than purchasing a blanket policy, the players sliced the risk into distinct categories: regulatory expropriation, tariff-setting interference, and physical force majeure, and auctioned those specific risk profiles off to separate syndicates of international insurers, driving down the total cost of insurance by an estimated 42%. Third, the governance model abandons the traditional 50-50 deadlock structure in favour of an asymmetric algorithmic voting matrix. In classic joint ventures, critical decisions often grind to a halt when the two primary stakeholders disagree. This architecture eliminates that vulnerability by introducing an independent, data-driven tie-breaking mechanism. The governing board consists of 9 seats, 3 appointed by the Sovereign Tech Fund, 3 by the Industrial Consortium, and 3 independent directors chosen via a blind, meritocratic selection process managed by an international arbitration forum. More importantly, operational control is governed by a dynamic Key Performance Indicator (KPI) escalation protocol. If the project meets its quarterly deployment milestones, the Industrial Consortium retains full operational autonomy. However, If performance dips below 92% of the projected efficiency baseline for 2 consecutive quarters, voting power automatically shifts toward the sovereign fund's representatives, allowing them to step in, restructure management, and stabilize the operational footprint without triggering a formal legal default. Fourth, the financial architecture features a highly sophisticated reverse waterfall distribution mechanism. In conventional corporate finance, profits flow strictly from top to bottom. Senior debt gets paid first, followed by junior debt, and finally, equity holders take the remainder. This deal flips that logic on its head during the critical ramp-up phase to incentivize rapid infrastructure deployment during the initial 48-month stabilization window. All excess operational cash flow above the minimum debt service coverage ratio is diverted away from equity dividends and immediately plowed back into a capital expenditure acceleration fund. Once this fund hits its mandatory cap, the distribution sequence shifts to an accelerated amortization schedule, paying down the principal of the Tranche A senior debt far ahead of schedule. Only when the overall leverage ratio drops below a conservative 40% threshold does the traditional waterfall resume, unlocking massive, unencumbered dividend flows for the equity sponsors. This aggressive deleveraging strategy ensures that within the first 5 years, the project becomes virtually immune to sudden shifts in global interest rates. Behind this complex blueprint stands a carefully curated ensemble of global power players, each bringing a specific form of leverage to the table. The Sovereign Tech Fund provides the unassailable balance sheet and regulatory cover required to clear bureaucratic hurdles across multiple borders. The Industrial Consortium brings the proprietary technology, supply chain dominance, and boots-on-the-ground engineering expertise that money alone cannot buy. Finally, the elite tier of institutional mega managers provides the global credibility, validating the structural integrity of the deal and signaling to the broader markets that this project is a viable, long-term asset class. The strategic brilliance of this layout lies in its sheer scalability. By avoiding standard corporate debt structures and relying instead on this modular, asset-backed SPV framework, the partners have created a plug-and-play model. They can replicate this exact financial and operational blueprint in 4 different regions over the next decade without needing to renegotiate the foundational terms from scratch. Every legal clause, every risk-sharing ratio, and every governance trigger has been stress-tested through thousands of algorithmic simulations to survive hyperinflation, political regime changes, and black swan market contractions. As the analysts in the room scrambled to digest the dense financial modelling displayed on their screens, the true scope of the announcement began to sink in. This wasn't just a defensive maneuver to survive an erratic economic landscape. It was a massive offensive land grab disguised as a structured corporate alliance. The architects hadn't just built a pipeline for capital and infrastructure. They had engineered an economic superhighway that their competitors were completely unprepared to navigate. And yet, as flawless as this technical blueprint appeared on paper, it contained one hidden, highly volatile variable that the algorithms couldn't fully account for. A human element that was already beginning to fracture behind closed doors.